People with money in an indexed mutual fund lost 40% twice in the Great Recession. People who had IUL didn't lose a dime during the Great Recession. In this episode, I'm going to address the question or the myth that indexed universal life is simply a permanent insurance policy where the cash values are invested in an indexed mutual fund. Nothing could be further than the truth from this statement. That is a myth. And there's a lot of advisors out there. This is what they tell their clients, and their clients are unfortunately missing out. So listen, I'm going to show you the difference between an index fund and an indexed account with an IUL. So I'm Doug Andrew. I've been helping people optimize assets and minimize taxes now for nearly 5 decades. If you've watched very many of my episodes on this channel, my favorite financial instrument to help people accumulate money tax-free and then be able to access that money tax-free, and when they ultimately die, anything they leave behind blossoms, increases in value, and transfers income tax-free, is a max-funded indexed universal life insurance contract. We use those for living benefits. If it's structured correctly and funded properly, it is deemed a laser fund. Laser is an acronym that stands for Liquid Assets Safely Earning Returns. It's also the title of my 11th book that I want to gift you a copy of at the end of this episode, so stay with me. So there's a lot of, well-intending advisors that simply don't know what they don't know. And oftentimes they say, oh, that's just a life insurance policy where they're investing your cash values in an index mutual fund. And I just roll my eyes and I go, man, they don't know what they don't know. So let's talk about the difference between an index mutual fund, which is like a commodity, and indexing, which is a strategy. So let's go to this Great Recession period. And I like to use the worst case scenario because this is the worst 12-year period since the Great Depression. And it starts in November 8th of 1999 and ends November 8th of 2012, to where people finally were back to break even. So if you had your money in an index like the S&P 500, Standard & Poor's 500, so that's a standard measurement or index. If you had your money in the S&P 500, your money's in the market. So let's say that you were a baby boomer that had saved your lifetime and had $1 million at the beginning of 1999, actually going towards the beginning of the turn of the century. And we're going to do November of 1999. And so you got $1 million and it's in the market. Maybe it's in IRAs or 401ks. And so those people felt like they had lost their future. They had to put off retirement 7 years with their money in an index mutual fund because the S&P went down 3 years, 2001, 2003, 2004, okay? And it was the 9/11 terrorist attacks. So it went down. Many Americans lost 30 to 40% or more. So $1 million went down to $650,000. Now, they felt like they'd lost their future. You've got to have some predictable income. And when the market's going down, you don't want to take money out of your account because that sequence of returns, it'll make your account crash and burn within 15 years maybe. And so timing is everything if you leave your money in the market. That's why my 3,000 clients I had in mutual funds in 13 Western states, clear back in 1980, were never happier than when I got them out of the market and into indexed universal life starting in 1997. But in 1980, it was just universal life. But they were earning, 11 3/4 to 15.5% from 1980 to 1990 tax-free. So what happened to these people that had their money in the market in the S&P, it took 4 years to come back to break even, to where their million that went down to 600 grand came back to $1 million again. And so we call it, it's like a lost decade here, but it's actually 12 years. And so these retirees, they said, oh, okay, now we can maybe retire. We're barely back to break even. And then what happened in 2008? The mortgage meltdown. As Warren Buffett put it, he said when the tide went out in 2008, it revealed who was swimming naked. Yep, they weren't protected, and they may have had $1,093,000 at a peak, and it dwindled down, and they lost 30, 40, and some 50%. So now it's down to 600 grand again. It took 4 more years until November of 2012 to get back to break even, barely above it. They finally had $1,046,800 for the million they started with. That's a pathetic 1/3 of 1% compounded annual rate of return. That is an indexed fund, okay? I don't want that. I don't want to lose. IUL, Indexed Universal Life, I'll show you what it did, but when the market started heading down in 2001, see, our clients didn't lose because their money, their million, is not in the S&P. It's in an insurance company, and back then, the insurance company's general account portfolio rates were 5 or 6%. Let's just say 5. Or even 6. During this decade, many of them were more like 6, 6.5. So if they were earning 6% on all of their billions and trillions of dollars in AAA bonds and AA bonds and mortgages on shopping malls and skyscrapers, they need about 1 of those percentage points for them. So maybe the net was 5. So if you understand indexing, that $1 million stays safe in the insurance company earning 5%. So if we didn't know about that 9/11 terrorist attack, which hardly anybody did, I'm sure, then we would have been thinking, okay, man, the market's heading south, and we didn't want to lose. Well, if you chose to link to an index, the million is safe in the insurance company earning 5. You simply told the insurance company, you can take the interest on my million, that 5%, which would be 50 grand, and you can use that $50,000 to do whatever you need to do with it to have the wherewithal to pay me whatever the S&P does if it goes up. Okay, so the insurance company is using that $50,000 for an options budget. They buy upside options in the S&P. If the S&P goes up 8, they'll credit you $80,000 on your million that year. If it goes up 12, they'll credit you $120,000. They may cap it at a certain amount. Back then, the caps were 16 and 17%. So if it went up 16, they'll pay $160,000, but no more. That's called a cap. But if the market crashes like it did, the options expire worthless. Those $50,000 of options expired worthless. But I still have my million. So you got 0, but you didn't lose. Now, Will Rogers once said people get more concerned about the return of their money instead of the return on their money when things go bad. Now, if you sat there for 3 years, you would have earned 0, 0, 0, but you wouldn't have lost. Your money would have been right here. But if you are familiar with savvy IUL professionals, the ones we train in a group called IUL Insiders, they learn how to rebalance. And so a simple way to rebalance is after 1 year of going down, we just told our clients, move back over and just earn the 5% and tell people stop rubbernecking on the economic freeway. So in most decades, they're 7 up years compared to 3 down years. 70% of the time, the market is up. That decade, 50% of the time, the market was down, only 50% up. Do you know that if you would have not rebalanced and you would have sat there and earned 0, 0, 0, 0, 0, and the other 5 years you would have only capped out twice, your average return would have been 7.23%. Rule of 72, your million would have been worth $2 million in 2010, okay? Probably $1,300,000 by 2012. $2 million, 300 or 400 grand. And so that's without rebalancing. But because we only had 2 years where they got 0, the other 3 years, they still earned 5, they came out ahead. Instead of 7.23, they averaged 11.17. That's called rebalancing. So Indexed Universal Life is very flexible, but the message is this. At the end of this 12-year period, when people who had money in an indexed mutual fund, the S&P index fund, their million was barely above the million again. They lost 12 years. Inflation eroded that away. They might have $1,046,000, but it won't even buy what $1 million bought 12 years earlier at a 3% inflation rate. People who had indexed universal life, at this point, that million had grown to $2.5 million and even $3 million tax-free That's the difference between an index fund and indexed universal life. Indexing is a strategy. Your money is not at risk in the market. So when you superimpose this and you look at that period, that's why do you want a pathetic 1/3 of 1% compounded annual rate of return? When you compare that to an indexed universal life, and this isn't even a rebalancing, this is just leaving it in the same one, you may not make very much when the market goes down. You may not make anything, but you don't lose. And so at the end of the day, this one, without even rebalancing, has 130% more than they started with. It's more than doubled. This one only had 4.68% more. Which one would you rather have? Okay, that should be a no-brainer. So if this is intriguing you, I want you to understand this thoroughly, because so many times advisors out there will say, oh, all that is a life insurance policy with cash values that are being invested in the market and an index to diversify it. No, it isn't. You would have lost 40% twice. That's a variable life insurance policy. An indexed universal life is not an index fund. It is indexing as a strategy. There's a big difference. If you want to learn more, I want to gift you a copy of this book. It's called The Laser Fund. It's been flying off of our warehouse shelves, and we send out hundreds of these every single week. You can go to Amazon. They're $20 on Amazon and, another $10 for shipping and handling, but you don't need to do that. I'll gift you a copy. You simply can claim your free copy by going to laserfund.com, laserfund.com, or click on the link below. And when you go in there, you'll contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I'll pay for the book. I'll fire out a hard copy to you via priority mail. And then if you're in there and you like to listen and learn or watch and learn, there's audio and video formats. Check out the educational webinars we do on a regular basis. They're free. You can even schedule an appointment with an IUL professional who has passed proficiency exams that I oversee. And with no charge or obligation, they will help you understand and see how a laser fund can be structured correctly so that you can take advantage of this incredible tool. You won't regret it. This is one of the most powerful retirement planning tools I have ever seen in the 50 years that I've been a retirement planning specialist.